Greetings, everyone. It's David Darst here with a recap of the month of February. As you know, a 29-day month this year, once every 4 years. Starting out with the two-year Treasury, you had an increase of 40 basis points, and it closed the month, the two-year Treasury, in the 4.67% neighborhood. The 10-year was up 20 basis points to 4.26, and the 30-year U.S. Treasury rose 9 basis points to 4.37%. The main reason, of course, was the increase in inflation expectations and the fact that people think the Fed's going to delay in terms of when they start cutting interest rates. Earlier on, back in January, as you know, the market, Fed funds futures markets were pricing in the anticipated first cut interest rates at the March meeting. The NASDAQ, which is the technology-heavy index, NASDAQ was up 5.7% in the month of February. The S&P 500 was up 5%. And don't forget, those technology stocks do occupy a very large percentage weighting of the overall market capitalization of the S&P. NVIDIA was the big star of the month of February. As you know, they had a blowout earnings, blowout margins, blowout revenues, and blowout guidance. All of that means much more positive than originally anticipated. NVIDIA, it started this year at $495 a share. Towards the end of the month, it was $788 a share. It's up 28% in the month of February, up 28% in the month of February. Now, inflation, the Fed minutes were released towards the end of the month, and in those minutes, the Fed governors and the Fed regional bank presidents said they basically consider the risks of cutting too soon to be greater than the risks of continuing to wait. So they really want to see inflation coming down. And what are they looking at? They're looking at the health of the labor market. The labor market is what you really need to be watching right now, and that continues to be relatively strong. The economy is percolating along. It's solid. It's not super robust. It's not showing too much sign of weakness. The first quarter GDP estimates of the Atlanta Fed, 2.9%, first quarter GDP annualized. The lead economic indicators have been down now for 23 months in a row. This is almost unprecedented that it'd be down so long, and we've had no recession. We are in the opinion at in our thinking at our asset allocation investment strategy committee discussions that we will continue going down slow, but maybe skirt or even dip slowly. You had Japan and the United Kingdom both entered official recession territory, but by 1/10 or 0.3%. Retail sales were very, very disappointing, the most recent numbers, but they often have substantial revisions, and you, of course, have anything around the holidays and the beginning of the year. There's often revisions to the retail sales numbers. So the economy looks okay to us right now. Earnings, 3.6%, with 90% of the companies having reported earnings here by the end of February. The year over year for the fourth quarter looks like it's going to be about 3.6%. And that, by coincidence, as of FactSet's latest earnings insight monitor, FactSet is predicting 3.6% for the first quarter on a year-over-year basis. Domestic politics. In the month of February, you had the South Carolina primary. You had other voting of some of the early states, okay, New Hampshire, Nevada. And right now on the Republican side, you see ex-President Trump is in the lead right now. And there's been some withdrawal of financial support from Nikki Haley. So that's on the domestic political side. And right now there's been no move by the Democrats to change anything as far as their candidate, Joe Biden, president, may be running for a second term. We'll see. All of this is in a state of flux. So don't make any assumptions that things could not change significantly in the weeks ahead. On the domestic political front, you've got to also factor in the discussions about the budget. And this is a big year. You're going to have to refinance $10.1 trillion of the government's $34 trillion debt. And it's going to be refinanced at basically double the interest rates that we were working with last year. So that's going to be something. I don't think the market, who's going to buy all this Treasury paper? That's the question that many of the Treasury bond dealers are asking themselves. On the geopolitical front, you still have the situation Russia-Ukraine, you have the situation Israel-Hamas, and you have the situation of course, in Asia. So these things remain unsettled, and Treasury Secretary Lawrence Summers, and also former president of Harvard, he says he does not think the market is pricing in the possibility of some surprises on that front. Basically, our takeaway this month is you need new justification for the stock market. It's up 5.7% in that neighborhood. For it to keep going, you basically have high valuations right now, 22 times earnings. 22 times earnings for the S&P 500. Forward earnings makes sense when you have 0% interest rates and quantitative easing. Right now, we have 5.25 to 5.50 policy interest rates and quantitative tightening. That's where the Fed is reducing its portfolio. So, to get the market moving higher, you're going to need some new justification on the sentiment, and the CNN puts out a composite of fear versus greed. 0 is very fearful. 100 is very, very greedy. Right now, that reading is at 78, which means extreme greed. Back in October, as you know, October 2023, excuse me, the fear number was 20, which means extreme fear, okay? The fear-greed index. For the market to move higher, you're going to need new justification because you're basically coming in with somewhat of a bullish cast right now. Inflation moving down, the economy doing fine, no surprises. All of that is priced in right now. As we look forward, early in March, you have Super Tuesday. That's going to have Texas. It's going to have California. It's going to have Virginia. It's going to have Tennessee. It's got something like 16 states plus American Samoa will be casting their ballots on Tuesday, the 5th of March. On the 6th of March, you're going to have Jay Powell give congressional testimony to the House. And on the 7th, you'll have him give testimony to the Senate. And that night will be President Biden giving the State of the Union address. So there's a lot of things in this early part of the month that could be setting up to change the market's direction. We still like, in this kind of an atmosphere, we like alternative investments, private credit, private real estate, private equity, including the purchase of secondary interests in private equity funds. Finally, you're going to have the next Fed meeting will be on March 19th, March 20th, and I think that we'll get some commentary. Probably no action, but more comments people will be looking at. With that, we thank you for being with us, and we look forward to catching up with you very soon.